In this video, Jim Cramer analyzes the current stock market's volatility and the emotional impact on investors triggered by political developments, in particular, tariff announcements. Cramer discusses anticipated earnings this week from companies like Oracle and Dick's Sporting Goods, while advising careful timing on purchases due to market conditions. Cramer also encourages gradual investments and diversification amidst market instability, suggesting opportunities in restaurant stocks and a specific interest in POW Industries.
And selling low before you watch the market bounce right back as it did today, with the averages opening decently, then just getting hammered. And then coming right back up. The Dow finishing up 223 points. S&P advancing 0.5%. And the Nasdaq, after being so hideous I could barely look at it, gaining 0.7%. How can markets be so out of control? And they are. Well, because, frankly, we are in a very emotional market. It's a market that's torn between buyers who see terrific opportunities because the market's down and the Walmart White House, where the president keeps trying to give you everyday lower prices on stocks almost every time he talks. I wish I were kidding. This morning, we got this non-farm payroll report from the Labor Department, and frankly, it was a perfect set of figures for the bulls. Decent job growth, not a lot of inflation. That's a great setup for investors who suddenly petrified that we're going to head into a recession, thanks to President Trump's mercurial attitude towards implementing his own agenda. But once the market opens, we hear that the president wants to put on new tariffs. I don't even know on who. And that's going to happen today. Then some moronic money manager decides to sell billions of dollars worth of tech stocks and economically sensitive stocks at once, while taking those proceeds and simultaneously using them to buy recession-proof names. That's what you saw today. The companies that make toothpaste, Uncrustables, Goldfish. It's the kind of colossally stupid move that distorts the entire market and misleads everyone who's watching the ticker. Not me, because I've done these trades, I've done these programs, and I saw it coming. Nothing kills confidence, though, like the whippy nature of these trades combined with the fear of presidential pain. So you get something like the fabled cascade of selling that almost always marks a short-term bottom, which is why I say breathe, because if you can't, this will be a Toto market for you. Toto, as in turn off the oxygen. And with that little explainer, why don't we see what's lurking in our game plan for next week? First, remember, we are in a clubber-lang market. No dispute about that, right? A la Rocky III, where the prediction is pain. And pain gets dispensed regularly, especially even on the weekend. Nothing stops. So we should expect to come in on Monday with a whole new set of parameters about trade policy. And that's a big reason why we're seeing such violent repositionings on Fridays. They're afraid. The accounts are afraid. Individual earnings have been de-emphasized by the president's arbitrary dispensing of tariffs. And, of course, suspending of tariffs with each waffle that we see people leaving this market, because I believe the stock market is still the greatest engine of wealth creation in history, but I often feel at cross purposes with the president now, even though I'm generally pro-tariff, because our trading partners never play fair. But in the end, I'm a process guy. I like a planned rollout of tariffs. While Wall Street never likes tariffs, what it really hates, though, is uncertainty. It hates that more than tariffs. In this environment, individuals feel like individual stocks, they feel like playthings. Playthings of a White House that feels at war with itself. They're not playthings, though. And you can't think of them that way, or else you're going to miss some tremendous opportunities. For example, on Monday, Oracle is going to report. And we'll do it after the close. I bet they're going to have some really positive things to say. Now, Oracle, a very good software company, has become a great data center company, which was terrific until we learned that some Chinese outfit could create high-quality AI models using much less hardware. That's a simplistic way to put it. But let's just be honest. The AI stocks have never traded the same since China revealed its DeepSeek source of, let's just say, of incredibly fast but much less expensive AI. Does it make sense that that's the case? No, it just doesn't. But it certainly hurt the valuations of the semiconductor stocks. Last night, Broadcom reported an amazing quarter. Its stock initially roared after the close. Then it got dragged down by that tech sell program I just mentioned, before bouncing right back when that ridiculous contrived program was over. And it finished the day up more than 8%. But were you in there from the beginning to the end? Many people probably left at midday. This kind of action has become the norm. I expect Oracle to have almost as good a quarter as Broadcom and then do the same thing. We've got some retailers reporting on Tuesday morning. I'm keying on Dick's Sporting Goods, which is pulling away from the others in the sports category. I think they'll deliver a very strong set of numbers, and it jumps like a pole vaulter when you get that kind of number. So it might be worth being in. Wednesday, we get another chance to throw the market under the bus when we see the consumer price index number. If the CPI runs hot, I'm sure the numbers from a stock like Oracle simply won't matter at all. C'est la vie. I'll tell you this. If we get a soft CPI and a soft PPI on Thursday, the drumbeat of a rate cut will grow so loud it might even overshadow the pain forecast for the White House. With cooler inflation readings, the Fed has no reason not to cut. The most important report of the week comes Wednesday after the close, and that's when Adobe reports. It's got to break the spell of undeserved negativity surrounding its stock. I bet CEO Shantanu Narayan will deliver something that makes the stock worth owning into the print. Dollar General reports Thursday morning, and this one's been all over the map lately near the bottom of it. I think this company and Dollar Tree have become the odd men out as Walmart has hammered prices so low that these guys can't compete. Dollar stores, I don't know. They seem to be at the mercy of the big suppliers, not Walmart. I am not a buyer of Dollar General or Dollar Tree. One stock I am a buyer of, though, is Costco, which reported excellent numbers last night and still got obliterated. Wait until Tuesday and then buy some. All the sellers will probably be done. It's a long-standing position for my Travel Trust. I actually want to buy more. I haven't wanted to do that in a very long time. After the close, and by the way, it did not miss earnings. That's just wrong. Those are people who don't know how to read Costco's report. I do. After the close, we hear from Ulta Beauty and the new CEO, Keisha Steelman, has to explain how Ulta remains the most relevant, reasonably priced cosmetics chain. Prices have to be kept down to beat all the discounters, while we're trying to get a bigger slice of the makeup pie. Cosmetics have become the biggest battleground in the entire store, and Ulta's got to win them back from Amazon. Finally, Friday, we get the Michigan consumer sentiment number. I didn't focus on this number much at all under President Biden because Biden was very predictable. So it was easy to make plans. Sure, Wall Street hated many of Biden's policies, especially on interest, but he rarely took us by surprise. Trump surprises us every day. You see, that matters because we're a consumer-driven economy, people. If optimism rules, there are some otherwise very risky stocks that are just quite simply worth buying. But if the pessimists are in charge, sell. Well, then all sorts of money managers will dump their economically sensitive stocks only to watch them power up once they're done, like that moron manager did earlier today, wrecking midday's market. Again, the markets can handle any amount of negativity. What they can't handle is uncertainty. The bottom line, look, it's one of the toughest markets I've seen in years because if your portfolio is a quarterback, you have no defenders and you're getting sacked or being from the blind side every time. And let me tell you something, all sides are not blind sides. So if you want to buy a stock, make sure not to buy it all at once. Buy slowly because the stock you purchase might be down 5 points by the time you get your report.